Welcome back to our channel. So last week gold dipped below $2,000 an ounce. In this video I'm going to mention why we think gold could potentially hit $2,200 an ounce, a few red flags overlooked by the US Fed, and at the end I'll mention names of two junior gold producers which we think are highly undervalued. One of them is trading at a 90% discount. Alright, so in the past few days gold was down $50 an ounce and currently trading below $2,000 an ounce. The key driver of this movement was higher than expected inflation, strong jobs data, higher consumer confidence, and rising yields. All of these imply that the Fed could be less dovish than previously anticipated. Now, we believe that the Fed will start cutting rates in June. That said, there's a risk of delays because the Fed has a tendency to overcompensate things. They were slow to raise rates during COVID, and they have been showing signs that they will be slow to cut rates as well. We believe the Fed has been so razor-sharp focused on inflation that they are overlooking several critical red flags. I'm going to show you a few charts. Number one, rising consumer loan defaults. As shown in the chart here, consumer loan defaults have been rising in the past 4 quarters. Number two, declining personal savings rate. As shown in the chart, the savings rate is close to record lows. Number three, rising auto loan and credit card defaults. Last year, credit card defaults were up 50%. Number four, declining labor force participation. Since the onset of the pandemic, the labor force participation rate is down by a full percentage point, or 1.7 million people. And number five, mortgage payments are up significantly in the past 2 years. About 40% of the outstanding 84 million mortgages outstanding are up for renewal in the next 2 years. On top of that, compared to pre-pandemic levels, home buyers should earn 60% more to afford a home. Bottom line, all these points suggest that the Fed should start cutting rates sooner than later to avoid a potential crisis. And one of the best asset classes in a decline rate environment is gold. The last time the Fed cut rates, gold was up 30% within a year. We believe gold could potentially hit $2,200 an ounce this year. Here's shown in the chart, gold is correlated to the US M2 money supply. In the 20 years before the pandemic, gold was up 9% every year, while the M2 money supply was up 6%, which means there's a 1.5x relationship. Now, since the beginning of the pandemic, money supply was up 5% every year. Using the 1.5x relationship, we believe gold should be moving at 8% per year, or it could hit $2,230 per ounce this year. With that, I'll leave you with names of two gold juniors that we think are highly undervalued. Number one, Golden Minerals. Shares are listed on the NYSE. This company started production from a silver gold mine in Mexico. We believe their shares are trading at a 90% discount relative to its comparables. To Steppe Gold, shares are trading on the TSX. They are the largest gold producer in Mongolia. This company can potentially double its production in the next 2 years, and we believe the market is assigning zero value to its upside potential. That's what I have for you today. If you like our content, please support us, subscribe to our channel, like, share this video. I'll be back with you next week with more ideas.